Retiring before Medicare eligibility can be one of the most expensive healthcare periods in anybody's retirement. In this video, I'm going to show you how to strategically use premium tax credits by managing your income so you qualify for the highest credit available to you. So we're going to use an example of John and Sally. John and Sally are both 60 years old, so they're 5 years away from Medicare. It's a pretty big bridge, and they need $100,000 a year to cover their retirement budget. So how they access that $100,000 is going to determine two very different outcomes when it comes to their health insurance. So what we're looking at here, I'm using the KFF calculator. I'm going to put a link to this in the description of the video. So what we're seeing here is their $100,000 of modified adjusted gross income. Now I'm going to spend a second just on that. There's a lot of different ways that modified adjusted gross income are calculated. For the purposes of premium tax credits, it looks at things like wages, self-employment income, it looks at capital gains, dividends, interest, and it takes a look at the total Social Security benefit that a recipient receives. And I'll spend a second just on that. Total benefit received counts toward modified adjusted gross income. This gets confused often because only up to 85% of the benefit is taxed. It's not looking at the taxable benefit. It's looking at the total benefit. So this plays a key role in determining whether to claim earlier or later, especially when it comes to impacting the costs of health insurance. So looking at this example, we've assumed that John and Sally are taking 100% of their income from their tax-deferred accounts, which is all taxable income. So it's reasonable to assume that their modified adjusted gross income will be the $100,000. In this case, that puts them over the 400% poverty line level, which means they're not eligible for any offset in premium tax credits. And in this case, they're going to have a premium of about $2,600 per month. That's 32% of their total budget. Now let's take a look at it a little bit differently. Let's assume that they had saved both into a tax-deferred account and also a non-taxable account, like a brokerage account. Let's assume that they need the same $100,000, but they take it from their brokerage account by selling investments. I'll assume that the investments had a gain of $50,000. Now, modified adjusted gross income includes capital gains. This is the only other source of income that John and Sally have. Their modified adjusted gross income estimate is $50,000. That's a very different scenario. So in this case, they are eligible for premium tax credits because they're only at 236% of the federal poverty level. So they get a benefit of about $2,300 a month. Their premium goes from $2,652 on average to about $330 a month, which is 4% of their overall anticipated budget. This is a much more doable scenario than the other, but it all comes down to understanding how it is that they need to save to get to this point. So if you're looking at this video and you're in your early to mid 50s and you're thinking to yourself, I want to retire as early as I possibly can, these are a real thing. So saving in a combination between non-taxable accounts, tax-deferred and tax-free like Roths, and if you're eligible through your company, healthcare savings accounts, all of those give you more choices as to how it is that you're looking to claim your income. And in those bridge years before age 65, those costs can be considerable. The other thing to take into consideration, which I tend to find a lot of people have questions on, is whether or not to do Roth conversions. Well, while you're on this bridge, every dollar that's a Roth conversion counts towards your modified adjusted gross income, which is going to increase the health insurance costs. So there needs to be a consideration given to how much those additional dollars of income are going to reduce their overall ability to be able to get the healthcare premiums. So let's assume that they did that. Let's say they said to themselves, they wanted to save themselves long-term by doing a Roth conversion. So let's say we added another $10,000 worth of income. So in this case, we're looking at $50,000 of capital gains and $10,000 worth of Roth conversion for $60,000. What does that cost them? So in this scenario, where they're doing a Roth conversion and also trying to manage their overall capital gains, that's $140 or so difference. It's about $1,700 a year. The difficult thing to quantify is we can take a look at right now what the cost would be. About $142 a month of additional health insurance premium costs. That we know, that's certain. What we don't know with the Roth conversion is how long John and Sally are both going to live and what the future tax environment looks like 10, 20, or 30 years down the road. There's no way to know that. So with those variables unknown, there has to be a trade-off. And that trade-off is, do they take advantage of the lowest cost premium that they could get today? Or do they do a combination and say, I want to be able to save myself potentially taxes longer term? But that's all built on longevity and tax rates. It also comes down to how much of their income they're going to have to take from their IRAs longer term. We need to reconcile the claiming of Social Security along with when it is that their mandatory distributions come into effect. And if that impacts things, there's a host of different items that need to be taken into consideration here. But in the isolation of just this event, managing and maximizing premium tax credits in these bridge years is important. That still gives John and Sally another 10 years to do Roth conversions. So the cost to them, the difference is about $1,700 per year. Not insignificant. I'm sure John and Sally could figure out ways to be able to spend that money a bit better than paying health insurance premiums with that. Now, keep in mind too, this does not include prescription costs and deductibles. This is just the health insurance premium. So depending upon John and Sally's health and their need for healthcare, those additional costs could come to bear, which would impact their overall monthly budget. But in the case of what we're looking at here, making sure that if you're anticipating it's part of your plan that you're looking to retire pre-age 65, this is a reality that you have, which is how are you going to be able to get health insurance before the federal benefits kick in at age 65? So if you found this video helpful, please hit the like. If you found a series of videos that you've been watching helpful, consider subscribing, and I'll see you in the next video.